So imagine it's a Tuesday morning in early April 2026. News breaks of a missile strike halfway across the world in the Persian Gulf.
Right.
And by Friday afternoon, the cost to repair a fender on a delivery van in Queens, New York, jumps by 20%. Today, we're dissecting the invisible financial tripwires that connect global warfare directly to your local storefront.
Yeah, it almost feels like a glitch in the matrix, when you look at it that way. I mean, a local business owner in Brooklyn or New Jersey usually looks at international news as, well, just a tragedy on the global stage.
Exactly. They don't typically view it as something that dictates their quarterly margins.
Right. After all, a local restaurant isn't exporting goods to the Middle East, and, a regional plumbing supplier isn't a multinational defense contractor.
But they are completely financially tethered to those events.
Mm-hmm.
And to help us, to help you, the listener, untangle this web, we're doing a deep dive into a really fascinating briefing.
Oh, it's a great one.
Yeah, it's put together by Constance Sung. She's the founder of Blue Rock Insurance Services out in Flushing, New York, and she brings 30 years of underwriting experience to the table.
Which is huge. She really knows the nuts and bolts of this stuff.
Totally. Her report is titled U.S.-Iran Conflict and Insurance, What Small Businesses Need to Know. And she maps out exactly how early 2026 military activity causes these immediate destructive shifts in local commercial policies.
Yeah, it's eye-opening.
So our mission today is to sort of shortcut your way to spotting these systemic risks that are just hiding in the fine print of your contracts before disaster actually strikes. Okay, so let's unpack this.
Let's do it.
We really need to start at the top of the insurance food chain, right? Because even if a local shop does zero international trade, their insurance premium doesn't exist in a vacuum.
Right. If we connect this to the bigger picture, you have to look at the mechanism of risk pooling, specifically something called the reinsurance ripple.
The reinsurance ripple. Okay, break that down for us.
So your local insurer, the actual company name printed on your storefront's policy, they don't hold all of your risk themselves. Doing that across thousands of businesses would be, well, financial suicide.
Right.
Instead, they buy their own insurance from these massive global entities called reinsurers. We're talking about global giants like Swiss Re or Munich Re.
Oh, okay, so reinsurance is basically like a neighborhood's electrical grid, right?
Well, that's a good way to put it.
Yeah, like if one house surges, the local breaker trips and the local insurer handles it. But if a massive catastrophic lightning storm hits the entire city?
The main power station has to absorb that immense shock to prevent the whole grid from melting down.
Exactly.
Right, so these global reinsurers are that main power station absorbing the global shocks.
That is a perfect way to visualize the architecture. Those global reinsurers are deploying capital to back multi-billion-dollar marine operations, international aviation, global energy sectors.
They're highly exposed, extremely exposed. So when a conflict breaks out in a critical region like the Middle East, ships are damaged, oil facilities are disrupted, cargo is lost. The power station basically takes a massive multi-billion-dollar hit.
Wow.
And to recoup that lost capital and maintain their reserves, they are forced to hike their rates across the board globally.
Which then trickles down to the local insurer.
Right.
Who then passes that increased cost to, like, the bakery in New Jersey.
Got it.
But let's ground this in the physical world for a second. How does an international conflict actually change the physical property insurance for a building? Or, say, the commercial auto policy for a fleet of vans?
Well, it comes down to inflation and the immediate cost of raw materials. So let's look at physical property first. A conflict in the Persian Gulf introduces intense volatility into the oil markets.
Fair. Gas prices go up.
Exactly. And when energy costs spike, the cost to manufacture and transport raw materials, we're talking steel, lumber, PVC pipes, asphalt, it just goes through the roof.
Oh, I see. Meaning the actual cost to hire a contractor and rebuild my shop in Brooklyn is suddenly, 20 or 30% higher?
Right. Even though your physical building hasn't changed at all.
Wow.
In the insurance industry, that specific metric is your replacement cost. Your premium is calculated based on what it would theoretically cost to rebuild your business tomorrow if it burned down.
Gotcha.
So if the cost of steel and PVC skyrockets, your replacement cost limit has to be raised so you aren't severely underinsured. And, well, a higher coverage limit mathematically requires a higher premium.
Okay, that makes perfect sense for the building itself. But what about the delivery vans? I mean, fuel costs obviously go up, but there has to be more to it than just gas prices impacting the insurance rate.
Oh, there is. Constance Sung highlights a mechanism called claims inflation.
Claims inflation?
Yeah. So global supply chain disruptions mean physical car parts like semiconductors, specialized bumpers, sensors. They take much longer to arrive from overseas.
And time is money.
Exactly. Because they're scarce, they cost more to acquire, and the specialized labor to install them costs more. So when a delivery van gets rear-ended in Queens, the insurance company is suddenly paying out significantly more for that exact same repair than they would have, say, a year ago.
Wow, so that direct increase in the severity of a claim leads straight to higher rates for both commercial and personal auto policies.
You nailed it.
Okay, it's easy to focus on those physical supply chains, the ships, the steel, the car parts. But a business in 2026 isn't just a physical storefront.
Not at all.
It's a digital node. And that brings us to this invisible vulnerability. The briefing makes it really clear that modern geopolitical conflict has opened a highly destructive second front that targets the U.S. economy directly.
Yeah, cyber warfare is really the defining feature of modern geopolitical tension. State-sponsored hacker groups frequently target U.S. financial institutions and small to medium enterprises.
And the goal isn't just stealing data.
Right. No, not always. The goal isn't always to extract a ransom. Often it's just to cause pure economic disruption to the adversary.
Now, here's where it gets really interesting. Hidden inside most standard insurance policies, whether that's property, life, or even cyber policies, is a massive loophole called the act of war exclusion.
Yes, the act of war exclusion.
Because traditionally, this meant if a foreign military dropped a literal bomb on your warehouse, your standard property insurance wasn't going to cover it. War is considered an uninsurable catastrophic risk for private markets.
Exactly.
But applying that to a digital attack completely changes the game.
It does. It creates a complete nightmare scenario for risk managers. If your business's servers get locked down by ransomware and the insurer determines that the attack was part of a coordinated military operation by a nation-state like Iran,
they might point to that act of war exclusion and deny your claim entirely.
Right. They will argue it wasn't a standard crime covered by your policy. It was an act of asymmetric military warfare.
But hold on, wait. How on earth does an insurance adjuster sitting in a cubicle in Ohio prove that a ransomware attack came from an official foreign military base?
That's the million-dollar question.
Hackers use proxies, right? They route their attacks through servers in 5 different countries just to mask their origin. Proving attribution sounds practically impossible for a private company.
It is incredibly difficult, and that ambiguity is the core of the legal debate happening right now. Proving official attribution often takes years of forensic investigation.
Years?
Yeah. It usually requires federal intelligence agencies to step in, analyze the code, and formally declare who is behind a specific malware strain. An insurance company can't just casually decide it was a state-sponsored attack without heavy formal backing.
Okay, but if it takes years for intelligence agencies to prove attribution, does the insurance company have to pay out in the meantime?
Well, because insurers hate this prolonged ambiguity, they aren't waiting for a cyber Pearl Harbor to figure out the legalities. They're actively tightening their policy language today.
Oh, I see.
Yeah, you might find new, incredibly broad language in your cyber policy regarding nation-state hacks or warlike action. If your policy loosely defines any state-backed digital interference as an act of war, you have a massive gap in your coverage.
So what's the fix?
You need to look for specific language to close that gap. Specifically, you want to look for carve-outs.
Okay, I want to make sure we understand this. How does a carve-out function in this context?
Basically, a carve-out is an exception written back into the contract. You specifically want to carve out for cyber terrorism.
Got it.
This clause dictates that even if a digital attack has some, political or ideological motivation, as long as it isn't part of a declared conventional war, the policy will still respond and cover your damages.
Okay, that's huge.
It is. It provides a vital safety net so you don't get caught in the legal crossfire over who exactly deployed the code.
Wow, okay, so we have digital threats and cyber loopholes. But the briefing also dives back into the physical world to look at what happens when the literal flow of global goods is obstructed.
Yeah, let's talk about geographic choke points.
Right. What's the biggest one here?
The most glaring vulnerability highlighted in these early 2026 scenarios is the Strait of Hormuz. For anyone without a map handy, it's a very narrow waterway between the Persian Gulf and the Gulf of Oman. A staggering percentage of the world's oil and an enormous volume of commercial shipping passes through it every single day.
So if you are a local restaurant waiting on imported commercial ovens, or an office relying on specialized electronics, Any restriction in that strait is devastating.
Absolutely. The alternative route the briefing mentions is sending ships all the way around Africa's Cape of Good Hope.
Oh man, which does what to the timeline?
Doing that adds 15 to 20 days to the transit time.
Wow.
Yeah, for a small business managing tight inventory, a 3-week delay can halt operations entirely. But operating in those zones isn't just slow, it's heavily penalized financially. Underwriters slap war risk surcharges on marine cargo rates the moment a commercial vessel gets near a conflict zone. The cost of simply moving your goods across the ocean spikes overnight.
That's brutal. And there's another financial tool mentioned in the briefing that I suspect many people haven't thought about, and it deals with cash flow. Explain trade credit insurance to us.
Right, okay. Let's say you manufacture components in New Jersey and you sell them to a buyer in Europe. You give them terms, maybe they have 60 days to pay you after delivery.
Sure, standard business.
Exactly. Trade credit insurance protects your business if that foreign buyer goes bankrupt or defaults. It ensures you get paid.
Okay.
But during a geopolitical crisis, insurers evaluate certain volatile regions and decide the risk of buyers defaulting is simply too high. So they might make trade credit coverage prohibitively expensive or just pull it entirely for those regions.
Oh, wow. So suddenly you're shipping your products overseas completely unprotected.
Yep, taking on massive cash flow risk just by conducting your normal business.
It is wild how quickly peacetime financial tools just evaporate.
It really is.
Which brings us to a really eye-opening section of Constance Sung's briefing. The specific exclusions hidden in everyday policies. I mean, we've touched on the commercial property military strikes aren't covered due to the act of war exclusion, but what about workers' compensation?
Oh, this one is tricky.
Because if my employee gets hurt, state law mandates I cover their medical care, right?
Yes, the basic statutory medical benefits are heavily protected by state law, so the injured worker gets care. But a standard workers' comp policy also has an employer's liability portion.
Okay, what does that do?
This protects you, the business owner, if the employee decides to sue you over the injury or the conditions that led to it.
Ah, okay.
And the briefing warns that this liability protection might actually exclude war-related injuries under a warlike action clause, meaning your legal shield drops entirely.
That is terrifying. Let's look at travel insurance too, because this affects almost every business that sends people to conferences or client meetings.
Oh, definitely.
If I buy a policy today for a business trip to the Middle East next month, and the conflict is already headlining the news, I'm assuming I run into a wall there too.
You do. That falls under the known events clause. You see, insurance is designed for the sudden and accidental. Once a geopolitical conflict is foreseeable, once it's dominating the front pages, it becomes a known event.
Right, so you can't buy insurance for a house that's already on fire.
Exactly. New policies won't cover trip cancellations related to it. And what's really fascinating here is how these various clauses interact with local government responses, particularly the civil authority clause for business interruption insurance.
Okay, let's break this one down. Because reading through this section of the brief, it feels like a cruel irony for business owners.
It really does. So business interruption insurance is supposed to replace your lost income if you are forced to close. Now imagine a conflict escalates, and the U.S. government decides to shut down local commercial ports or restrict domestic airspace purely as a preventative security measure.
Okay, so you can't get your supplies, you can't operate, and you're bleeding revenue every single day.
Right.
Now, naturally, you'd assume that because the government, a civil authority, forced you to shut down, your business interruption coverage kicks in to save you.
You would assume that. But the fine print almost always dictates that coverage only triggers if there's direct physical damage to your actual premises first. Or, to an immediately adjacent property.
Are you kidding me?
Nope. If the port is shut down purely as a precaution, but your building is perfectly intact, you likely have no coverage. The insurance company essentially says, your windows aren't broken, so we aren't paying.
Wait. So the government forces me to lock my doors, I lose a month of revenue, and because a bomb didn't literally hit my roof, I get nothing. That is infuriating.
It is. It forces businesses to absorb the entire loss themselves.
Wow. It really underscores why understanding the mechanics of these contracts is so vital. I mean, we've talked about supply chain delays, complex legal loopholes, massive surcharges. It sounds incredibly bleak.
It can feel that way, yeah.
But Constance Sung's brief doesn't just list things to panic about.
No, she provides a roadmap for small businesses to regain control.
So what does this all mean for you, the listener? Let's get into the action plan.
The core philosophy of the briefing is that while you cannot control international waters or state-sponsored cyber attacks, you can absolutely control your own risk profile. There are 3 defensive strategies business owners can execute right now to harden their operations.
Okay, let's get into the mechanics of how to actually do this. Strategy number 1, audit the supply chain.
Right.
Now, when you say audit the supply chain, that sounds great for a massive corporation with a dedicated logistics department. But how does a local plumbing supplier actually execute that on a Tuesday afternoon?
It starts with a very pointed conversation with your primary vendors. You don't just ask where your vendor is located, you ask where their Tier 2 suppliers are located.
Digging deeper.
Exactly. If you discover your inventory relies on raw components passing through the Strait of Hormuz, you need to pivot to near-shore suppliers. Moving your critical material sourcing to Mexico or Canada might cost a few cents more per unit on paper during peacetime.
Sure.
But bypassing those marine shipping spikes and 3-week transit delays during a crisis, that makes it a brilliant investment in resilience.
That makes total sense.
Okay.
Strategy number 2, harden cyber defenses. And this ties directly back to that ambiguous act of war cyber exclusion we discussed earlier.
Yes. You do not want to be stuck in a multi-year legal battle with your insurer over whether a ransomware attack was a standard crime or an act of war. Prevention is honestly the best insurance you can buy.
So what are the practical steps?
Make your business a hard target so automated, state-sponsored attacks just bounce off and move on to weaker prey. Implement multi-factor authentication MFA across your entire network today. Ensure you have robust off-site backups that are entirely disconnected from your main system.
So don't rely solely on the policy to save you after a breach. Which brings us to the 3rd step, update valuations. We discussed earlier how inflation and energy costs spike the price of raw materials like steel and lumber.
Right.
And the briefing explicitly warns that property limits need to reflect 2026 rebuilding costs. If a local bakery suffers a fire and their policy is still based on 2021 construction costs, what is the practical outcome?
They will be hundreds of thousands of dollars short when they try to hire a contractor to rebuild. This requires active management. You cannot just renew your commercial policy on autopilot every year.
Which means getting your insurance broker on the phone.
Right.
So what exactly should a business owner be asking them to ensure these bases are covered?
Well, this raises an important question about how you communicate with the people managing your risk. You really need to ask 2 specific questions based on this briefing.
Okay, what's the first one?
First, does my current policy have a cyber war exclusion? And how broadly is a nation-state attack defined?
Right. And the second?
Second, can we add a TRA rider?
Let's unpack TRA really quick. That stands for the Terrorism Risk Insurance Act.
Yes. It's a federal backstop created after 9/11. If an event causes massive commercial damage and the Secretary of the Treasury officially certifies it as an act of terrorism, the federal government steps in to share the losses with private insurers.
Oh, wow.
Yeah, so having a TRIA rider on your policy ensures you have access to that federal backstop if your business is caught in the crossfire of a certified event. It's a vital layer of protection that a lot of small businesses actually decline just to save a few dollars a month.
Interesting. And the briefing notes that if you want a comprehensive review to check for these exact vulnerabilities, or if you just aren't getting clear answers from your current setup, you can reach out directly to the experts at Blue Rock Insurance Services.
Highly recommend it.
Their number is 718-886-6601. They specialize in this specific kind of deep dive risk assessment.
It is entirely about moving from a reactive posture where you're just a victim of global events to a proactive one where your business is insulated.
So we've seen how a conflict thousands of miles away acts as a massive systemic risk to the entire insurance market. It doesn't stay neatly contained overseas.
No, it doesn't.
It travels through the reinsurance ripple, driving up the cost of the PVC pipes you use to fix a bathroom, and weaponizing the highly specific legal language guarding your company's servers.
The reality of early 2026 is that risk is borderless. The businesses that survive are the ones that update their coverage limits, understand their exclusions, and actively manage their supply chains.
I want to thank you for joining us on this deep dive. Navigating the fine print of commercial insurance is rarely anyone's idea of a good time, but hopefully this breakdown helped demystify the complex web of global risk. Before you go, though, let's look at this from one final angle.
Yeah, we've spent this entire time talking about protecting your business today. We framed this knowledge as a shield, but think about your competitors down the street.
The ones who are still renewing their policies on autopilot without reading the terms.
Exactly. The next time a geopolitical crisis hits, the The businesses that didn't audit their supply chains, that didn't check their cyber exclusions, and that didn't update their rebuilding valuations, they won't just struggle. Many of them will go bankrupt while waiting for insurance payouts that are never coming.
Wow.
In an era of hyper-globalization and interconnected digital infrastructure, does a purely local business even exist anymore? Or is every storefront essentially a micro-multinational corporation, whether they want to be or not? In 2026, understanding the fine print of your insurance contract isn't just a defensive measure. It might actually be your most aggressive competitive advantage.
Definitely something to think about the next time you check the morning news. Until next time.
Thanks for listening to today's episode. No matter what type of insurance you're looking for, home, auto, business, or specialty coverage, Blue Rock Insurance Services is here to help you navigate it with confidence. If you need guidance, quotes, or a second opinion on your current policy, reach out to us anytime. We're here to make sure you get the protection that truly fits your life. Until next time, stay safe and stay insured with Blue Rock.